Malcolm hit the contribution limit last February. $24,500 redirected out of every paycheck right on schedule. He felt good about it. Responsible. Like someone who had finally figured out the game. He had not figured out the game. If you are 35 to 50 and you have been maxing your 401k because it feels like the financially mature thing to do, this is not about saving less. It is about the sequence. And the sequence is where most disciplined savers quietly lose. There is a concept in personal finance called the order of operations, not a single name study, not a famous paper, just a framework that every fee-only CFP eventually arrives at after watching clients do the right thing in the wrong order for 20 years. The core idea is simple. Which bucket you fill first and how full you fill it determines more of your retirement outcome than almost any other variable. Get the order right and the math compounds in your favor. Get it wrong, you're paying what I call the order tax, the silent penalty for optimizing the wrong thing at the wrong time. Let me show you where the gap lives. The first check is the one that costs the most per dollar missed. And almost no one does it before they set their contribution rate. Malcolm logs into his benefits portal when he started his job. There was a field for contribution percentage. He typed in the number that would get him to the annual max. He thought he was done. But he had skipped one question. What is the exact threshold where my employer stops matching? Here's why that question matters. The most common match structure in the country right now is 50 cents on every dollar you contribute up to 6% of your salary. That means to capture the full match, you need to contribute exactly 6%, not 4, not 2, 6. Now picture two bars. The left bar is Malcolm's employer match. The right bar is the match his colleague Maya captures, same company, same salary of $90,000. Malcolm contributes enough to hit the annual max. Maya contributes exactly 6% and stops there for now. Both are doing well. But only Maya captured the full employer match in the cheapest way possible. Malcolm did too, but only by accident because he went past 6% on the way to the max. The problem comes when cash gets tight and savers drop their contribution rate. If they drop it below the match threshold, the left bar disappears entirely. Free money gone. According to Fidelity, more than 1 in 5 employees leave at least some of their employer match unclaimed. On a $90,000 salary with a standard 3% match, that uncaptured amount is $2,700 a year. Gone, not deferred. Gone. Over 30 years at 7% compounding, that $2,700 annually grows to roughly $270,000. That is what I call match then math. Capture every dollar of match first, then decide how much further to go. This is dollars in the decades. If you want to see the math that most finance content skips, subscribe. It costs you nothing and it might save you 6 figures. Now here is where the order gets more interesting. Once you have confirmed your match threshold and you are hitting it, the next question is not how much more to put into the 401k. It is what to check before you add another dollar. Check 2 is about a trap that does not exist on the contribution form. It lives in the fine print of the plan documents. Malcolm is 47 years old. He has been maxing his 401k for 6 years. His balance is solid. Then his company restructures. He gets laid off at 52. He needs income. He looks at the 401k balance of $400,000 and tries to access it. The IRS charges him a 10% early withdrawal penalty on top of ordinary income tax. On a $100,000 withdrawal, that penalty is $10,000 out the door before a single bill gets paid. Now here's the part most people do not know exists. If Malcolm had left his job in the year he turned 55 or later, the IRS gives him a specific exception. It is called the Rule of 55, no early withdrawal penalty. The money is accessible penalty-free from that employer's 401k as long as he does not roll it into an IRA first. Roll it into an IRA and the exception disappears. The IRA follows a different rule. Age 59 and a half. No exceptions for early separation. The Rule of 55 is a real option for people who might retire early or face job loss in their mid-50s. But it only helps if you stayed in the 401k. And it only helps if you actually have liquid assets to bridge the gap from whenever you leave work until 55. This is the liquidity check. Before you lock another dollar into a 401k, ask yourself one honest question. If I lost this job tomorrow, how many months could I cover my expenses from money that is not in a tax-deferred account? If the answer is less than 6 months, maxing a 401k above the match threshold might be the wrong move right now. A taxable brokerage account or a high-yield savings account does not give you a tax deduction on the way in, but it gives you something the 401k cannot. Access, no penalty. No form to file, no permission required. Some savers treat the 401k like a higher interest savings account. It is not. It is a locked box with a tax advantage attached. The tax advantage is real and powerful. But the lot matters when life does not follow the schedule you planned. Check 2 is simple. Run the liquidity test before you set the max. 3 to 6 months of expenses and accessible money. Then decide how much to lock away. Now here is the twist. The one most people never see coming, even after they get the first 2 checks right. Check 3 is about a number that does not show up on your paycheck stub. It does not show up in the employer match calculation. It shows up in a document most people receive once and never open again. Malcolm found it eventually. He was 3 years into maxing his 401k when a colleague mentioned expense ratios at lunch. Malcolm went home, pulled up his plan summary, and looked at the funds he had been defaulted into. The target date fund he held had an expense ratio of 1.1%, not outrageous by old standards, but the national average for equity mutual funds inside 401k plans has fallen to 0.26% as of 2024. The gap between those 2 numbers sounds like a rounding error. It is not a rounding error. Picture a single bar growing over time. Start with $25,000. Add $10,000 a year. Let it grow at 7%. Now watch what happens to that bar depending on which expense ratio you pay. At 0.26%, the bar reaches roughly $490,000 after 30 years. The bar just grew. Now apply 1.1% instead. Same contributions, same market return. The bar shrinks, down to roughly $380,000. The bar just shrank. The gap between those 2 outcomes is roughly $110,000. Not because of market timing, not because of contribution amounts, because of a number buried in the plan summary that most people never check. The Government Accountability Office ran a similar analysis. Someone contributing $20,000 a year for 20 years in a plan costing 1.5% annually ends up with about 17% less than someone in a plan costing 0.5%. More than $10,000 difference on the same inputs. This is the order text in its quietest form. You did everything right. You hit the max. You stay consistent, and the fee structure quietly charged you a 6-figure toll that never appeared on any statement as a line item. The fix for check 3 is 10 minutes. Log into your plan, find the fund options, compare expense ratios. If your plan offers an S&P 500 index fund or a total market index fund, those typically run between 0.03 and 0.15%. Switch to the lowest cost option that matches your risk tolerance. You cannot control what the market does. You can control what the plan charges you to participate in it. Now, the natural objection at this point is that maxing the 401k is still a good idea after all 3 checks. And that objection is largely correct. The tax deduction is real. The can pounding is real. The employer match is free money. None of that changes. But here is what does change with SE Share 2.0 for a specific group of savers. If you're 50 or older and your income was above $150,000 in FICA wages last year, your catch-up contributions in 2026 must go into a Roth account. Not pre-tax, after-tax Roth. The IRS finalized these regulations in September 2025. That changes the math for some people. If you expected a large pre-tax deduction from catch-up contributions and your plan has not yet added a Roth option, you may not be able to make those catch-up contributions at all until the plan amends. Check with your HR department before assuming the contribution will go through the way it always has. This is not a reason to panic, it is a reason to check. The strongest case for maxing, regardless of order, is this. The tax deferral on $24,500 a year is significant. If you are in the 24% federal bracket, that contribution saves you nearly $6,000 in taxes this year. No other single move gives you that. For someone with stable income, a fully funded emergency fund and a long runway to retirement maxing first may genuinely be optimal. The auto tax only applies when one of three things is missing. The match threshold is not being hit. The liquidity buffer does not exist. The fund lineup has not been checked. If all three are covered, max away. Here's the protocol. 3 checks executable this week. Check 1 is the match threshold audit. Log into your plan. Find the exact formula your employer uses for matching. Write down the minimum contribution percentage you need to hit to capture every dollar of match. Confirm your current contribution rate is at or above that number. If it is not, adjust it before anything else. Check 2 is the liquidity test. Add up the cash you can access without penalty and without selling retirement assets. Divide by your monthly essential expenses. If the result is less than 6 months, pause any increases above the match threshold and build the buffer first. Taxable brokerage or high-yield savings either works. Accessible matters more than tax efficient at this stage. Check 3 is the expense ratio scan. Pull up your plan's fund options. Look for the expense ratio column. If your current fund is above 0.5% and a lower cost option exists in the same category, switch. Do not change your asset allocation, just move to the cheaper share class. The market return stays the same. The fee drag disappears. 3 checks, 1 hour of work. The math it corrects can compound into 6 figures over a career. Max is not a destination. Max at the right time in the right bucket after the right checks. That is matched in math. En evoke het roken into 3-part at the 3-part of Batisnance. And the first part at the Nation. Drop a comment with the result of your expense ratio check. What are you currently paying and what is the cheapest option in your plan? If you are 35 to 50 and you want this kind of math every week, hit subscribe. This is dollars into decades. I will see you in the next one.